No matter which way you look at it, the stock market looks extremely overvalued, and there's no shortage of market crash content out there. I mean, every time we see a red candle, there are hundreds of millions of videos that come out talking about a market crash. Here's why I'm investing anyways. Now let's talk about the stock market for a little bit, because it seems like every week we're hitting all-time highs in the stock market, which in itself isn't a problem. The problem relates to the underlying earnings of the stocks that we are buying. Because the stock market is a place where people can buy shares of businesses. And the question is, how do you value a business? And generally speaking, over the long term, earnings drive the value of business. Now, of course, there are other ways to make money in the stock market that don't have anything to do with fundamentals. Think momentum trading and day trading, all that stuff. But I'm really talking about long-term investing here, at least the kind of investing that people say they are doing when they're investing in stocks. And what we've seen, especially in the last couple of years, is that stock prices have largely decoupled themselves from the underlying business earnings. And when I say earnings throughout this video, what I'm talking about are the profits that a business might be throwing off. So when a business's earnings increase, that really means that the profits are increasing too. And over the long term, what you see is that stock prices generally follow earnings. As earnings increase, stock prices increase, and as earnings fall, stock prices also fall. But stock prices have risen dramatically over the past couple of years, even though earnings have not really kept up with that same rapidity in the rise of the price. Take a look at the famous Warren Buffett indicator. This is a good high-level overview of the relative expensiveness or cheapness of the stock market. This number takes the total market cap of the entire US stock market and divides it by the total US GDP. So in other words, you're looking at price versus output. And the Buffett indicator is at by far an all-time high at over 200%. The most recent high was 150% back during the tech bubble in 2000. So the Buffett indicator would suggest that the market is very expensive, historically expensive. But maybe you don't like the fact that GDP is in the Buffett indicator, and GDP is kind of a weird measure in general. So how about earnings themselves? Let's look at the Shiller price to earnings ratio. And once again, this tells a very similar story. The Shiller PE is at a very high level, historically high. So this looks at all of the companies in the market and their total market cap and divides it by the earnings that these companies are throwing off. So very similar to the Buffett indicator, but more at a company level. But in this case, it focuses on earnings rather than domestic output. And once again, this tells a very similar story. Right now, the Shiller PE is around 40, which the only time it's been higher than that was back during the tech bubble in 2000. And over the past 150 years or so, whenever the Shiller PE gets above around 25%, it's typically followed by a pretty substantial crash. I'm not saying that's going to happen anytime soon, but that's what history has done. It's hard to argue against the fact that people are paying a lot of money for every dollar of a company's earnings right now. Based on the Shiller PE ratio, people on average are paying about $40 for every $1 of earnings right now. This historically has not proven to be a great strategy. But is there an alternative? Even if you think the whole market might be very expensive, there still might be some relatively undervalued companies that are cheap based on your preferences. And this is exactly what stock pickers will look for. They'll look for companies that have great growth or earnings potential. They're earning a lot of money now in many cases relative to their price. And then those investors wait for the market to agree with them over the long term because they're relying on the fact that, historically at least, earnings have been what really drives stock prices. Again, over the long term. In the short term, a lot can happen, as we're seeing right now. They're looking at business fundamentals. What is the company doing now? What does it look like they're going to be doing in the future? Making reasonable predictions, or at least you'd assume they're being reasonable, but hey, who knows? But this often takes a lot of work to actually be successful with. You have to look at company balance sheets, look at their earnings now, look at what you think their earnings are going to be. You have to do a little bit of fortune telling to try and figure out where a company is going to be going, so there's always some uncertainty built in. And this is something that I do for a large portion of my stock portfolio. I try to find relatively undervalued companies. Even if I think the whole market is overvalued, there should still be some undervalued positions that I could open in individual companies with good fundamentals based on my own analysis. It's this whole idea of focusing on investing in deals rather than investing in the whole market. But maybe you don't want to stock pick. Like I said, there's a lot of due diligence that often goes into this sort of thing. Are you screwed? What about just buying the whole market all of the time, or what a lot of people like to call dollar cost averaging? Now, the true definition of dollar cost averaging is where you have a pile of cash and then you are slowly investing that cash into whatever it is you want to buy across time. So you should be hitting the highs and lows of whatever that investment price is, and it should average out over time. But when most people talk about dollar cost averaging, what they're really talking about is just routinely investing into the market at pretty much any price. And when I say buy the market, they're typically buying a broad index, something like the S&P 500 or some broad index fund that has tons of different companies inside the fund, so you're really getting the performance of the entire market. You don't have to do any specific company analysis, you're just riding the market wave. And this strategy, at least historically speaking, has done quite well. Oftentimes this strategy outperforms many of the actively managed funds, which may have their own problems, but whatever the case, it's a very simple strategy that tends to work. But of course, there's no guarantee that this will be a great strategy in the future, but it has been to this point. Now, even though I actively invest for the majority of my stock portfolio, I still have a significant amount of money going towards my retirement accounts that are invested in broad indices. So they're following the whole market and I'm buying every single month. That way, if my individual stock picks go to zero, or if my real estate investments don't work out for whatever reason, I still at least have this broad market portfolio to fall back on. And if those go to zero, then we probably have other problems to worry about. But what strategy really makes sense? Whether you pick individual stocks or you invest in broad indices, your decision depends on your own risk tolerance. If you have no idea what you're doing when it comes to looking at a business's fundamentals, then you probably shouldn't be stock picking because you're going to end up being misled in some way, or you just totally don't understand it and you're shooting blind. And maybe you don't like the idea of having company level risk in your portfolio and just want to be exposed to market level risk. Company level risk could be something like fraud taking place at a company, and then that company goes to zero, and if you're heavily reliant on that one company, that's really going to hurt your portfolio. Whereas with a broad index, you have many companies that are within that index, so if one fails, you have many others to fall back on. That's one of the powers of diversification. Your personal financial situation is also going to play a huge role. If you have a bunch of debt, maybe you can't handle volatility because you need money sometime soon, investing in individual stocks or even investing in the broad market might not be a very good idea. In any event, risk is directly dependent on the price you pay for something. The more money you put into an investment, the higher your risk exposure is to that investment. So all else equal, if you like an investment at one price, if you get it at a cheaper price, that would be even better. And that's generally because it lowers your risk. Think about it this way: the more you pay for an investment, the greater the amount of productivity, the greater amount of return that that investment has to throw off in order to be worth it. They might say, I don't want any risk. I'm not going to do any investing because I don't want to deal with that. Well, not investing has risk in itself. Sure, you might not be investing in a company that has the threat of going bankrupt and then you lose all your money in that investment, but you have other risks, mainly opportunity cost. How much money could you have made had you invested? But on the flip side, you also have the ever-relevant threat of inflation, which would eat away at your purchasing power over time. So really, every investment or non-investment strategy has some level of risk. And it's up for you to decide how you want to address those risks. In short, the market, by pretty much every measure, looks very overvalued or very expensive, but I'm still investing anyways. I'm going to keep investing in what I think are great deals, and I'll still have some portion of my portfolio going towards passive indices and just buying into the market indiscriminately. And I'm always looking for ways to increase my income, both through investments and outside of them. That way, even if market values tank, I should have something to fall back on, or at least the ability to make up any lost ground from a bad investment. Time will tell what the best strategy is, but all I can focus on now is trying to get a good deal for the money I am investing. And that's what I'm doing. And what I'm doing depends on my own risk tolerance and my own financial situation. This is not financial advice. And if you need financial advice, go talk with a licensed financial professional. Anyways, if you guys like this video, please like it since that would help the channel out a lot. And if you want to see more content about investing topics, then be sure to subscribe since I put out new videos every single week. And check out those affiliate links in the description below. But until next time, take care.